Hey, yeah, what? Grab your bootstraps. Yeah, let's scale your growth. Here's the truth, Jack. We'll reach the globe, unveil the
Tanya,
notes.
what
Learn
the
to pivot,
fuck?
earn your digits. Won't burn, you'll get it. See, this is factual. Funds will show. Learn to flow with candid capital.
This is a Candid Capital interview. In these episodes, we host industry business professionals involved in the global tech ecosystem to discuss various topics related to tech, global economy, and building sustainable businesses and investments. Welcome to the Candid Capital podcast. This episode, we will cover market engineering and fundraising with Bruce Cleveland, the author of Traversing the Traction Gap. If you are a startup struggling to communicate your startup's value to investors, this discussion will provide some ideas and insights to consider in your fundraising journey. Welcome, Bruce. Thanks for coming.
Hey, you bet. Nice to be here, Josh.
Yes, I've been wanting to get you on here for a while, and I'm glad we were able to connect. Before we get into your origin story, I thought I would share with you that we kind of have an origin story. And this is how I discovered the traction gap, and it might be interesting for listeners. So I would say 4 or 5 years ago, I got investor relations added to the list of different things I do in portfolio management. And through that, I was kind of trying to write my own ebook and create a framework of some sorts, except it did not have any cool names. And I really just kind of had a general framework that I was working on. And then I had come across a webinar with you discussing the traction gap. So I immediately just deleted all those files. And then I grabbed your book to go into more detail. So needless to say, I have not created any framework or traction gap, as I felt as though yours covered it quite well. So that is my origin story, I would say, in finding the traction gap. And, for those listening and who will see this video, I have the book right here. And it looks a little bit worn, it doesn't have the new book smell anymore. But anyways, I like to practice what I preach somewhat. So with that, I would just like to get us started with your origin story, specifically to how you started working with entrepreneurs in technology, and then eventually how it led you to the traction gap.
Yeah, sure. It's a multi-decade career, so we're not going to go into every aspect of it. But I spent the first 25 years on the operating side running engineering or product management, product marketing, etc. Started out at AT&T doing a lot of fiber optic and other networking stuff. Ran into a small company. I was helping AT&T out with the project where it was working with a number of different government agencies, and ran into this little tiny problem, which we needed a database that would run from PC to mainframe. And this had to be in the 80s. So I ran into this company that said they could do that, called Oracle. It's a little tiny company in Menlo Park on Sand Hill Road. And I'll come back to why that matters in a second. But the net of it was that ended up working with a gentleman by the name of Tom Siebel, and another one named Larry Ellison, of course, both from Oracle. And decided at the end of the project, which we were successful in securing, I decided to join Oracle. So this is before Oracle was public, maybe less than 100 people. And I ended up being the sales engineer for Tom Siebel. So I did that for a number of years. He got promoted. I got promoted along with him for some reason. And I ended up running the Unix division of Oracle, which products and a variety of other things that we were developing. So doing that kind of set the foundation for what I did for the rest of my career in Silicon Valley, because most of my network came out of those Oracle contacts. Mark Benioff was a young product manager at the time. A lot of people, Oracle begat a lot of different people. People may not know this, but a lot of different companies, the founders or the a variety of different people came out of that, and I'm sure it'll be the same way out of Facebook or out of a variety of other organizations. So the net of it was that's kind of where my foundation started, and I did that for a number of years and ran that Unix division, and then went off and I ran an engineering division at Apple for a number of years. Apple kind of lost its way before Jobs came back, and I got this call from Tom Siebel, who had built or had started this company called Siebel Systems, which is really the creator of the customer relationship management category. And Tom said, "Hey, I think this thing has some promise." And so I left Apple because I felt that it was completely out of control, and joined Tom when Siebel was about a couple million in revenue. 4 years later, we were $2 billion in revenue with almost 10,000 employees, and I ran a number of different things for Tom, whether it was running products or running marketing or running the biz dev stuff. And so all of these things, the reason I bring this up is because it's all going to lead into this book I wrote. But the net of all that that opportunity was I ended up with the position of having to decide to go back to Oracle when Oracle acquired Siebel Systems. And I chose not to do that. That's when I kind of changed horses. I went from operating to investing, and I joined a company called Interwest Partners. And here's where the story goes back to Oracle, because Interwest was located on Sand Hill in the very same small number of offices that Oracle had been located in. So it was back to the future. I was actually in the same offices that I had started my career in Silicon Valley. So one of those strange twisting stories of, small world. I decided that at the time I didn't know anything about venture capital or really investing per se, but I did know how to build products, and I had built the software as a service group inside of Siebel Systems more recently, and that was relatively new. So this is 2006 when this happened, and I think Bessemer was out there with its metrics for B2B SaaS, which was great. Salesforce was now actually growing pretty rapidly, but the SaaS business model really wasn't generally accepted yet into larger companies at all. So I felt like, well, I have some knowledge about this, and I hung my shingle out to do investing in SaaS and in B2B SaaS specifically. And the first idea I said, well, I had on my drawing board this concept of marketing automation that I didn't get to do at Siebel because we sold the company and I didn't go with it to Oracle. I said, so why don't I invest in it? I'll either create the company myself or I'll find some people. Did a bunch of due diligence and ran into three guys with an idea, Phil Fernandez, John Miller, and Dave Morandi. And their idea was a company that didn't have a product yet, didn't have any revenue, and that was the only team. I don't know if a dog was involved, but maybe, maybe there. So, and that company is what became Marketo, and we were the only ones who would invest because they didn't have any traction, and we'll get into that in a moment. But that became kind of the foundational investment I made in B2B SaaS, and that ended up being a pretty powerful return for the firm, and sort of set the trajectory for me in terms of my investing across a variety of different companies, and almost all of them were just concepts. There were some that were in existence. Workday was an existing company, but it had yet to become what we all know it as today. And I used my network from Oracle to find new opportunities and people who I work with. They were engineers or they were in product or wherever they were. That's how I built up my portfolio of B2B investments. They included companies like C3AI, which is now a public company, Velocity, which was acquired by Salesforce, Marketo, as I mentioned, a company called Doximity, where we incubated that as an idea. That's now a multi-billion-dollar company that offers, I guess the best way to position is LinkedIn for physicians. So I found that I had done pretty well in investing, and I had built a bunch of proxies for myself. These were non-revenue based metrics per se, because the companies I was investing in had no revenue or no product. And basically no venture firms wanted to invest in them because they had not realized any type of financial metric that you could look at. I approached it differently, built these proxies, and I built the notion of a framework now called the traction gap framework. And it exists really from the standpoint from ideation through scale. And there's three phases to it. There's a go to product phase, there's a go to market phase, and a go to scale phase. And there's different things that we do or we have to do as investors or that we have to do as entrepreneurs to progress through these three different phases. Underneath it, underneath the actual traction gap framework itself, it's girded by four concepts: product, revenue, team, and systems. And those four pillars, if you will, take a different point of position dependent upon where you are in the phase of your company. And I describe a lot of this in the book. And the other piece of it is that there's really 4 or 5 value inflection points that you need to reach as an entrepreneur. And they go from, like I said, ideation to what I would call minimum viable category, which is what category you're going to compete in. From there, we go to our initial product release. We reach MVP, or minimum viable product, and I just adopted that phrasing and that vernacular because people are somewhat familiar with it. I have a different point of view on what it is. We can talk about that in a moment.
Have you seen anybody put that in a pitch deck who was not targeting you?
No, I haven't yet. One of the things I'm going to do, because it's been 4 or 5 years since I produced the book, is now there's enough time where people have a lot of people have read the book. A lot of people have adopted it, the framework. And so I'd like to go back and do an analysis of how many people have used the framework. I know a handful or a dozen of them, but I'd like to get a better, industry viewpoint on have they used it with other venture firms, et cetera. I think one of the reasons that one of my partners at Wildcat is a guy named Jeffrey Moore. And Jeffrey, I think we might all know as the author of Crossing the Chasm, which is an iconic business book. He's an incredible guy. And so he's the one that actually encouraged me to write this. I think everybody's familiar, maybe not everybody, but a lot of people are probably familiar with Jeff's book, even though it's been out 30 years. It's like its 3rd or 4th edition. He's, a lot of things have been built upon those concepts. I don't think my book has been quite as successful as Jeff's. So, but we'll see. We'll see what happens with now that 5 years has gone by and do a poll on this.
Well, it would be interesting to see, because like for the concepts in it that I've used with working with startups, it's really just how they can articulate in the pitch, the traditional slides. But it'd be interesting to kind of see is like how would you have your TAM slides or whatnot, how you would have sort of like an encapsulated traction slide based on some of the concepts in the book. That would be interesting to see. And I guess if it catches on, then that's success metrics there for sure. For
Absolutely. Well, I wrote it as a prescriptive guide. Jeff's book isn't really prescriptive. It's sort of it's a taxonomy, a way to kind of think about markets. And so he used this technology adoption lifecycle curve that's pretty familiar. He didn't actually invent that. That was invented, I think, in 1963. But he created this notion of a chasm. That is, you have to cross this chasm if you want to get into the general overall market. The reason that it's a curve is that there's area under the curve, and that area represents market size. So it makes a lot of sense. Mine is more linear. So it's progression from point A to point Z. And you need to reach the next point on the traction gap framework based upon the capital that you raised previously and or the revenues that you've been able to generate. But the main purpose that I wrote it for entrepreneurs is kind of a you are here guide, which means, hey, dependent upon where you are you at initial product release? Are you at this point that I call minimum viable repeatability, which means you built multiple versions of your product, you've sold it multiple times, you've hired people. It gives you, that's when you really change from being a PowerPoint company about how great it's going to be to a spreadsheet company, which is how great is it? So, and that's the point at which in the data shows MVR, minimum viable repeatability, is somewhere around 5 to 6 million of ARR. And this is actually where a lot of venture firms tend to invest. They really want to, the best brands, in the venture industry, the Andreessens, the Excels, the Kleiners, whatever brands we want to associate with them, the benchmarks. Um, the those folks can afford to wait until people have, quote, crossed the traction gap, so that they can actually evaluate the success or be able to make a much better determinant of whether the startup will be successful or not.
Well, what you're
Um,
describing there is kind of, the comment that you made online, kind of got this conversation going, which is, at around that 5-6 million point is probably where they're thinking that product market fit has been discovered. And as kind of product market fit versus what did you call it? Market product fit. And so maybe you could explain that a little bit.
yeah, it's funny because just recently, I think on LinkedIn, another firm came up with and said, "Hey, it's around it's around the market, not so much the product." So my point 5-6 years ago, what I recognize is that the product market fit is an interesting concept that is associated typically with minimum viable product, the MVP, value inflection point. So the issue there is that without a market, there's really no demand for your product. And so companies need to realize that markets just don't appear necessarily, that you have to actually engineer the market. And this is kind of really the foundational concept for my book, which is all around market engineering and why you really need to reach market product fit, not product market fit. Before you actually begin to create a market, before you can declare that there is a market, you have to engineer the market. So, and there's a set of tactics to do around that, and that's really what the book is about. So, the book is about market engineering using this traction gap framework as the reference points. The concept of the term came about actually on a walk I was doing with my daughter, and said, I don't think people my daughter's a CMO, so I told her, I said, I'm having trouble. I need to come up with a term for this issue, which is that most of these companies think that product engineering is what it's all about. And I go, product engineering, without great product engineering, there's really no need for you to create your company. I said, but I have found that that's not what wins the game. That's not really what makes you a market leader. What makes you a market leader is that you've defined a new category or redefined an existing category. You've established yourself as a thought leader in the category. People want to associate themselves with you. You're great at storytelling. That would be like Steve Jobs. He had a reality distortion field around him. He would get us to believe what he believed, and we would follow him. So you need to be great at storytelling, the reason for your company's existence. You need to be able to message and position. And so those are the 5 tenets that I came up, and I remember the sort of the eureka moment with my daughter. I said, the people need to engineer a market. And so I go, this is really what we need to call it, market engineering. And so that's become the term and sort of the foundational concept for the book, and why I say that it's really around market product fit, not product market fit. A huge mistake that a lot of startups make is that before they create a category or redefine one and establish themselves in a thought leadership position in it, they typically take in venture capital, and they hire an SDR team. They start a bunch of outbound email and phone calls. This is very, very expensive. And you can burn a lot of capital doing that. The problem is it falls on deaf ears. How many phone calls are actually answered? How many emails are actually responded to? And you can see this in these low conversion rates. Before you start burning Benjamins like this, you really need to invest in thought leadership in your category. And it takes some patience. It takes 12 to 18 months to actually define the category, do the work required, the work being conferences, books, speaking engagements, podcasts, not your podcast, other people's podcasts, like here, joining somebody else who already has a following, so that way your ideas are heard. So these are the mistakes that one of the big mistakes that a lot of startups make, is that they just start spending a lot of money. And the venture capital, community is somewhat at fault here, in that it says, okay, we put 5 million in. Let's get the SDR team on board. How many phone calls have been made? What are all these activities that are going on? And then they realize, hey, no traction is happening. We're not getting a lot of sales done. Well, that's just because nobody's listening to you. So that's really what the book is about, is how do you engineer a market? What are the value inflection points that you need to reach? And how do you go about doing it? What are the tactics that you as a company need to execute? And as an investor, what are the things that you should be looking for, either your initial investment or as you move through these various phases with the company? What is it that they're doing? And the purpose of the book is just to basically give you these reference points and prescriptive tips into how to actually do this. I've done it now personally as an operating executive and also as an investor. And I'd say that the results from both of those experiences have been, I'd say fairly successful. So I recently just did it with C3 AI, where I was the CMO. And the CEO, Tom Siebel, he said, I want to build a new category called enterprise AI. And I said, okay, well, let's take a look at how many people are already using that. Well, really nobody was. This is in 2019. He said, well, why don't we do this? We're going to build a set of tactics, strategies to do that. Content, a book, public speaking, conferences, whatever. And we're going to use this term over and over and over again. And we're going to measure it. So we wrote a bunch of Google reports that allowed us to look at how many people were looking up the word or the term enterprise AI, how many people were associating that with C3 AI. And we did that. It took about 12 months. And if you look up the term enterprise AI today, I think you'll find it's actually a pretty well recognized category. But it started with nothing in 2019. But I had a CEO and the board agreed that this was a really good idea and a good strategy. And we have metrics to measure it. What was the result? We didn't do any outbound, very little outbound. I had one SDR and it was all inbound vetting. So we had 3,500 inbounds a month, no outbound email, we did do some AdWords stuff, but none of this, spray and pray, and pretty high conversion rates, in terms of meetings, people who wanted to learn more about what we were doing and why we were doing it. So I'm pretty confident in the concepts. I'm pretty confident in that if you apply these prescriptive tactics, that they work, because I just did it.
So for an early stage or maybe a pre-revenue company, because you see their slide decks and it's always that their product is unique, their company is unique, and then it stops there. And so do you think that, in doing sort of the marketing engineering component, that perhaps maybe trying to articulate this new category in some way in the pitch adds some type of benefit, or do you see it more as just like a marketing tool for sales? Do you
No,
think
I
there's
think
a way to incorporate that in the deck?
yeah, I think so. I mean, when I work with companies now, what I do is we start with a messaging matrix. It's just a tool, a document that's blank, who we are, what we do, why we do it, what's unique about us. And it always begins with, what category are we in? Or what category are we going to either create or redefine? And we spend a lot of time on that because we position the attributes of the category up front, because people want to determine the companies you're selling to, the products that you're selling. People want to figure out how you fit in and stand out, right? Where do you fit into the architectural stack of technology that these companies have already purchased? I think the data I found, in a typical mid-sized company, there's a roughly 120 SaaS products that are already in play across the company. Sales, marketing, service, support. Everybody has a system of record, which we can talk a little bit about that versus a system of intelligence. But system record, that's largely why, you saw Salesforce missed its number, a quarter or so ago for the first time in 20 years. Well, it's largely because these systems of record have been saturated. And so when you go out there with your application You need to be able to explain exactly what problem you're solving, how you solve it, and why it's additive, and valuable to the company. And one way of the beginning of that is the category. This is where we fit in. So Siebel Systems created the customer relationship management category, CRM. Salesforce didn't create that. What they did is they found, oh, well, Siebel's selling this as an enterprise sale where they have to build all the servers and manage them, etc. Mark said, we have a better idea. We have this thing called cloud CRM. And so what you're going to be able to do, we'll manage all the servers. So they came up with a better, it turns out to be a bigger category than what we had built, as big as we had built it. But Mark didn't invent CRM, we did. So, but you need to position yourself against other category builders. Existing categories are like enterprise resource planning or business intelligence or, supply chain management. All these things have existing incumbents, and if you're going to offer a product or a service, people are going to try to figure out, where do you fit into the taxonomy of the industry? And why do I need yet another vendor, why do I need to write a check to yet another company, sign a different contract, and manage those things? So this is why you need to spend the upfront work in the development of the messaging matrix. And when you go to meet with an investor, you need to explain to them precisely the category you are going to create or play in. And the category is just a name for a business problem. So here's the other kind of ironic part to this. You may create the category, but you need players. So the way I talk, if you don't have other people competing in your category at some point, it's not going to be a category. So you need to actually invite others into it. The way I explain it is, think of a category as a stadium. So, and we're going to play a certain game in the stadium, and that game has rules. So that the category has a set of attributes associated with it. Those are the rules of the category. So if you're going to create a category, you got to build the stadium. You've got to create the rules for the category, and then you are going to try to install yourself as the best team in the category, which means the best company. And the way you do that is through thought leadership. So by doing it and doing a great job, and I talk about all the prescriptive things that you need to do in the book, by doing this effectively, and you can do it in your deck as well, by explaining what you're going to do, how you're going to build this category, how you're going to differentiate yourself in the category through books and podcasts and conferences, etc. If you're going to do that and build a category, eventually other people are going to enter that, and you want to compete against them, and you want to win. So I like the analogy because I've always been in sports, and so for me, this it's easy to grok and understand. A lot of people want to build a brand, which is build a team. Well, until you build the stadium, there's no need to build your brand. You need to get people looking for the problem that looking for a solution to the problem that you solve, and there needs to be a name, and so that name is the category name. And once that happens, then you need to be the brand or the team that's been associated with solving that particular problem. So I encourage companies, entrepreneurs, to invest time and energy up front into this market engineering exercise of what category are you in, what's the business problem you're solving, what's the name of that particular category. I'll give you one more example here why it's important. I'm working with one company right now, and they have a product. They were stuck in these sales cycles where they would go in, and in this case, the product is it helps to accelerate SBA lending. So if you're a lender of SBA loans, you have applicants and you have a loan officer and loan committees, and so there's a process that you have to go through. And there have been systems of record created to solve this a problem called loan origination systems, or LOSs. The problem that they were having was they would go into these meetings with banks, and they would spend half an hour doing yes but. The yes but was, well, we already have a loan origination system. They go, well, yes, but we have this additional capability that we bring to bear. So they would spend half of their hour that they were given trying to explain who they were and how they fit in and stood out against these loan origination systems. And I said, well, you're AI native. Let's not call it a let's call it something else. Let's build a new category called a loan intelligence system. And it's an agentic system. Okay, new language, provocative. Well, what's an agentic system? Well, now you're engaging somebody. They're talking to you about what your product does. A loan intelligence system. Well, what do? Well, we handle the first three aspects of an application process. Okay, how? Well, we make it easy for the applicant. 80% abandonment rates, we drive those down, and then we make it a lot easier for lenders. So now they're engaged in this conversation, a new category called loan intelligence systems. And once they made the change to the deck, to the positioning, and we built a messaging matrix all around this, all their go-to-market material, boom. No more.
Yeah, I can hear the founder. I can hear his voice in the conversation. He's like, but does your product do this versus do you have this? And explaining kind of the difference, which is kind of interesting. For the companies that you've seen go down this path of trying to do category creation, or that you've worked with, do you find there's like I guess a fundamental component of it where they're tripping over trying to create the category, like a key, I don't know, learning for going down this process? Or is it just a matter of just brute forcing it and doing the work to get it
Well, I
done?
think there is some. I mean, you do need to be creative about this. You need to. There's a couple of things you have to recognize. One is that you need to bring along um, a community with you in the actual category. That community, the people who will help you build it, are the industry analysts. They need to recognize that it's a category, and the way they do that is: are there enough companies they can sell research into, to be able to make a business from it? And so you need to compel them and conscript them to help you build the category. And on top of that, you need other competitors to enter and begin to use the same terminology. And so it's a process where you also can't use goofy names. They need to be names that are serious. So enterprise resource planning or supply chain management. They may be boring sounding, but they can't be unique just to you. You can't build a category of one company with something unique that a unique name that nobody else is going to want to use. So you have to kind of balance these things. And I usually play I play referee in this. I let companies actually draft the initial language for what they think the category name is. And then we go through a process to talk about it. The cool stuff is today we can use products like Perplexity and others. We can run these names, through them, and it can come back and suggest, alternative names. You can give it the description of what you think the category is, and these AI products can come back and make actually pretty intelligent suggestions. It may not be the one or the suggestion that you'll use, but it's much better than a thesaurus, and it gives you a pretty good idea about how maybe people will respond to it. And you can ask it to respond in different personalities. So you can give it, hey, we're selling a product to ideal customer profile X. Here's the description of the ideal customer. Here's the title. Here's what we think are going to be what we think are great category names for this. And then you can ask the AI, what do you think? And it's I've been shockingly surprised by some really good responses to this. And then you just apply human intelligence ourselves to it and say, okay, do we think that we can build something from it? So one thing I will say is, like, for example, with Marketo, we were looking to create a new category because marketing automation had failed. There were a number of companies in the 90s and late 90s and early 2000s where the category itself never took off for a number of different reasons. And so I suggested to Phil, I said, well, let's come up with a different category name. I think we were looking at revenue performance management, which is actually something in the healthcare industry. We eventually abandoned that though and decided let's just go with marketing automation. Let's just redefine the attributes of marketing automation, and that took off. So we solved the problem differently than others. We built these campaign journey builders, et cetera. So that allowed us to redefine marketing automation, and today it's a vibrant category. I think with like 8,000, 8,000 companies, and I don't know, a couple dozen subcategories, right? SEO could be one of them. So the net of it is that you don't have to always create a brand new category, but you do need to reinvent it. And the reason for this, my good friend Christopher Lochhead and a couple folks wrote a book called Play Bigger, and it's all about category design. What Chris found, what those guys found, is that 76% of all profits inure to the market leader, the category leader. So, scraps go to everyone else. So it's critically important that if you're going to come up with a new company, you have to enter or build a new category, because not only do they have 76% of the profits, they control the attributes of the category, which means you're basically it's fraught with peril to try to enter another category as it currently exists. It's likely you're going to get wiped out. So you need to invest this energy, and investors need to know this too. If you just have a company that's going to go in to be a fast follower, you're giving up 76% of all potential profits from whatever category you're in, if you can even survive. So I don't recommend that as a strategy for startups. I recommend let's go in and create a new one or redefine an existing one, and let's tell everybody how we fit in and how we stand out. With that company I talked about, that loan origination, loan intelligence solution, people are not going to rip out a system of record like a loan origination system or a CRM system or a supply chain. They're not going to initially rip that out. That is a recipe for disaster to force that to happen. You have to go in and show how you're complementary to what they already have. Eventually you can, elbow your way by creating more and more capability and more product. But to go in and suggest, especially for anybody who's in the B2B SaaS space, to go in and build something that to rip out an existing system of record, that is going to be that's a tough row to hoe. So it's better to fit in and stand out. And that's one of the reasons why I'm recommending that companies now consider these systems of intelligence, since they have the opportunity to build an AI native application, which we didn't really have that ability just even a few years ago. Figure out how to go into a category and offer something that's complementary to a system of records, something that enhances it and makes it work better, faster, and more reliably. So anyway, that's a long-winded response to your question, but the net of it is that I do believe that startups, early stage or otherwise, or even new products. So the other thing is that 60% of all new products launched from existing companies fail. 85% of startups fail. They're usually a single product company. That's B2B. And then B2C, around 96% of all startups fail. But new products also fail and so these same concepts, these same market engineering concepts apply no matter how large you are as a company. And so we need to consider these issues around category creation or redefinition. We need to consider how we're going to position ourselves how we're going to fit in and stand out inside of these companies where we're selling or where we intend to sell. We have to show people how all this stuff stacks together. And if you're an investor, understanding the prescriptive techniques that your company should be performing in what order is pretty critical, because you don't want to, if the company fails to reach one of these value inflection points on the capital and revenue that it currently has, then getting the next round of capital is going to be extremely hard. So this traction gap period from when you declare MVP, minimum viable product, with market product fit, to the next value inflection point, which is minimum viable repeatability, I've sold it a lot of times. I've hired people. I've built multiple versions. The $6 million ARR number. In between that long stretch, it's about a year and a couple of years, 2 to 3 years to get there. You need to prove that you have reached MVR on the capital and revenue that you raised previously. If you don't do that as the investor, you're going to have to bridge that company, and maybe or maybe not, and you may not, or may not have the funding to bridge them alone. And if you're going to then go have them talk to other venture firms, they're going to look at it and go, "Hey, you guys really haven't achieved very much, since your last round. We're not going to invest." So it becomes very difficult. So the game afoot, and whether you want to play it or not, you're in the game. The game afoot for investing, and as the investor and as the entrepreneur, is you have to reach these milestones, these value inflection points on the capital and revenue you have, in order to be able to assure that you can actually raise the next round. So the book is filled with the metrics of what you need to do, and also what these metrics are, because whether the venture capitalists state them to you or not, they know them in the back of their head. They know exactly where, it's a T2D3 model, triple twice, double three times that Battery created a while ago. These numbers, these metrics, the net retained revenue, NRR, ARR, CAC, all these different metrics are metrics that, when you're beyond just being a concept, this is how you're going to be evaluated. And so the book is all about, okay, well, what's the prescription, the recipe to go from wherever you are to get to these metrics that the venture community is going to be assessing you against. And if you're above the line, if you're doing well, great. Raising the next round of capital is not going to be that challenging. If you're below the line, you're in trouble as the entrepreneur and the investors, because now you've got even a more challenging point, because remember, the GP sitting on your board, that's just one of the partners in the firm. That person has to go convince everybody else, who also have their own portfolio companies that are all competing for the same pool of funds. And there may or may not be funding for your company. If somebody goes, you know what, we could use the extra 5 million to finance, Acme over here, because Acme's doing great. Your company's kind of floundering. So I think these metrics are critically important for both the entrepreneur and the investor community. And the language, the vernacular I've created, is just a way to communicate more effectively. It's a way for the board to speak to the entrepreneur. It's a way for the entrepreneur to speak back to the board. And it's a way for partners to speak to each other about, is the company progressing along the lines that we would expect? And if not, why? And what are we going to do about it? So that's why I wrote the book, was to give people something to ground themselves in, taxonomy, language, and a way to communicate more effectively.
Well, I think that makes sense because, I mean, if you think about it as startups competing with each other for fundraising, there can only be so many category killers or number one companies in the category. So if you're not doing this, you're likely targeting that 75% that you mentioned, and you're not likely a unicorn, which is a different investment strategy, or a type of investor versus, kind of the return objectives of a VC.
Yeah.
So, marketing or engineering the market, I think is critical, for any startups that are kind of going, I would say, for the winner take all or the IPO strategy versus maybe an iterative M&A strategy. And like coming back to talking about categories and whatnot, there's one category that I just wanted to mention, and maybe you're following it and might have some thoughts on it, but the metaverse, which I think is it has changed its category title, sort of. And so I would say Meta, to use your analogy, might have tried to become the stadium potentially. And so the industry has pretty much been trying to move away from that term. Mobile World Congress, metaverse is only used in referring to industrial metaverse. The Metaverse Insider publication changed its name because of the categories, I guess, negativity with it. Just to show sort of a reverse polarity of trying to name a category. They actually renamed their book the Digital Twin Insider, because you can't really have a serious conversation with the word metaverse in a lot of the corporate settings. I don't know. Have you been kind of following this at all, or noticed it?
Notice it, haven't followed that much, but I mean, it's you can't invite the world to help you create a monopoly. You know, so
that's exactly that's exactly what it seemed like.
so I mean, you can't tell everybody, hey, our which is what everybody realizes is going on, right? I mean, you can become one, you can become a monopoly, although you don't want to be legally defined as one. Amazon, Facebook, where there really only needs to be one winner, or there will be basically one winner. Um, no one's going to help you do that per se. And so I think it was a mistake to try to engineer that. And while you've also told people, I think they're going to rebel against it. They're going to find alternative things. So they don't want to be inside a walled garden that somebody else controls the gates. And I think that's really what's been going on there. Fortunately, I think in the B2B space, for the most part, no company can have world domination per se. There's always going to be room for innovation and improvement. And after running engineering at Apple, not all of engineering, but a large portion of it, or at C3 AI, what I can tell you is that, and I'm sure everybody who's listening to this, there are no spare engineering resources going on inside of a company, no matter how small or big. If it's a big company, the engineering resources are primarily dedicated towards the next incremental innovative feature, and typically those are either divided across defending a position or new revenue, right? There's some contract that's been negotiated, and it's dependent upon delivering a certain set of features. And then the other third part is technical debt, because over time, the architectural advantage you had that was a weapon has turned into an anchor. And now you're stuck with old stuff that you've got to continue to support. Well, the reason that startups can win is because they're not. They're just trying to figure out, all right, what are the latest and greatest technologies that we can use to develop something new. So the idea about creating your own, giant walled garden where you control everything, no one's going to really help you do that. Number two, in the B2B world, there's tons of people who are saying, look, no one's innovating here. We're going to create something new that solves these problems that exist, and we're going to show people, why it fits in and stands out better than everybody else. That to me is so an answer to why I think the metaverse stuff is, sort of, it can work, but it's got to work. It's got to be, subterfuge. You've got to, in the background, what you have to do is just continue to win more and more market share, and then as the market leader, like Salesforce, a lot of your innovation comes through acquisition, right? You didn't develop it internally. You said, oh, we need a great BI capability. Okay, we're going to acquire Tableau. Oh, we need software tools. Oh, we need this is kind of the domain of the large companies, where innovation internally becomes more and more difficult. They have to actually do a lot of their innovation through off-balance sheet R&D, and startups become those off-balance sheet R&D opportunities. It's also an opportunity for the startups to work with these larger companies and say, look, we bring innovative technology not built on some legacy architecture, but we can interoperate with what you have. If we go to market together, you solve a problem for us because the cost of going to market is extraordinary. We'll work together with you. We'll make joint sales calls. We'll do joint marketing together. You can sell more or prevent loss of your technology, and you'll help us out because we don't have the distribution or the credibility, right, that your brand has. So I think a lot of startups missed out on this too. They try to do everything on their own. When they go to a large company, kind of they tin cup their way in, and instead of coming at it from a point of strength, they come at it like, well, could you help us out? Well, the only way that company's going to help you out is if they realize that you have customers that want that company that you want to partner with to integrate. So you need to sort of enlist your customers, go to the bigger company together, and get them to agree, the larger company to agree to work with you. So and that helps to also eliminate your go-to-market costs too. The and we employed that strategy from inception at C3 AI. We employed that strategy at Siebel Systems. We employed it in some of the companies where I was an investor. But it's an area that's not really explored enough. I don't believe, by the investor community or whoever or the entrepreneurs. They going to market with a partner, picking one or two, where you're working together with them. You solve a problem for them, they solve a problem for you. I haven't found a lot of startups willing to do it, or not, or at least if they're not very good at it. I think it becomes kind of like a third rail kind of a thing, and so most just don't do it. They find it difficult to get engagement. They're not explaining the value proposition to the partner correctly. And a lot of times it goes like this: we want to come partner with you, and the reason we want is because we want you to go and knock on a door for us and then bring us in. That doesn't work very well. You've got to bring some assets into the reason why they want to partner with you. And I find not a lot of companies spend much time on on that on that direction.
So before we move into the fundraising question, you had mentioned about a 85% startup failure rate. Um, I find that number really hasn't changed much. It seems to be pretty static around 85% across multiple jurisdictions or markets. And I'm just kind of wondering there's probably no answer we're going to discover here necessarily on the podcast, but um, we're living in a time where there's so much more tools, there's so much more access to information. There's, lots of different people like yourself helping and teaching startups. And, like the access to knowledge is very deep in terms of whether you want to look at fundraising, sales, whatnot. And why do you think it's not really shifting? Is it just that competitive that it's just leads to ultimately 85% failure rates?
Well, I'm biased because I believe in these market engineering concepts, and I don't believe that many startups do them. I mean, there's innate market engineers out there, the Mark Benioffs, Tom Siebels, Larry Ellisons. I mean, they would never describe themselves as market engineers, but that's in fact what they are. Maybe the best of all time has been Steve Jobs. So um, most of the time what I find is that companies, they go, well, we're going to be sales led growth or product led growth or something, and then they put the bet is entirely on marketing, and my point of view is that that's a recipe for disaster for your company. The CEO needs to be the chief category designer. They need to be the person who leads the positioning of the company, the category design, the messaging, positioning, thought leadership. They can assign for execution to CRO, CMO, whoever, right, the different functions. But the reason companies continue to fail is because they don't invest in the right things at the right phases for the organization. So that go to product phase, go to market phase, and go to scale. There's a different set of things you need to invest in. And what I find is that a lot of companies have are acting and investing as though they've reached some kind of milestone that I describe in the book, when they haven't really done the work to get them to that particular milestone. So they burn a lot of capital, they make a lot of mistakes, they build the wrong product, they build a growth machine that's not for an industry that's not even listening to them. They spend a lot of money trying to rise above the noise and fail. So and then they don't generate the revenue, the metrics that their valuation is based upon. And so they get the venture industry loses interest, right? They go, well, we're not going to fund you anymore because you didn't reach these different milestones that we expected, revenue or otherwise. So that's I don't think human behavior has changed, over the last decade, maybe even the last 100, 200 years. I think companies still make decisions, they make buying decisions in companies based upon groups. There's usually multiple people involved in acquiring something, unless it's a tool. It could be an individual or a small group. But in general, like these larger B2B systems that cost tens of hundreds of thousands, maybe more, and they affect the business operations of the company, that generally involves a number of different people. And so I find that uh, if you don't engineer the market for you, where there's a recognized category with recognized business benefits, etc., you're going to spend a lot of time and energy, a lot of your capital, basically knocking on doors, trying to get somebody to listen to you. And that hasn't changed. That process we can add AI into the equation. It may happen, but it's not going to change. People are still going to be people. They're going to make decisions that they think will affect their career. Is this going to make me perform better? Is it going to make the company perform better? How, et cetera. And if you can't answer those effectively, you're going to have a hard time, getting your product in. And so, product-led growth, sales-led growth. I really think it's market engineering growth. I really think you have to engineer these markets, and you have to do it in a prescribed order if you want to give your company a better shot. The things I describe it's not a panacea. It doesn't mean it's always going to work, but it's worked often enough for me. It's been worked often enough for the companies I've either been an investor in, or I was the operating executive helping to execute it, that I'm confident that if you follow this market engineering process, I think we could dramatically reduce the failure rates. One, we might decide not to actually build the product in the first place. So that's part of the go to product phase, which is there really an opportunity for this? And then to my friend Phil Fernandez, I think he comments on this in LinkedIn quite a bit. Phil, the CEO of Marketo formerly, his comment is, there's just too much software out there. There's just so much stuff people trying to sell it. And I would agree with him on a couple of points. I don't agree with these new emerging systems called agentic systems. I think companies are going to invest a lot here, and I think it's going to be net new dollars that go into it, because it gives companies a competitive advantage. But you need to be able to quickly explain how this is all going to fit in, and how you as a company are going to survive if you want those committees and those people to bet their career on you. So the market engineering work that you perform will, I believe, mitigate the failure rates of products, and I think it could even mitigate. It may even prevent you, if you follow some of the process, the go to product phase that I talk about, or even what Steve Blank wrote, the Startup Owner's Manual. That's a pretty dang good book, prescriptive manual for product. Um, the If you can do this, you might not even build the product that you were thinking about. I know for a fact that Phil and John, those guys, actually a year in, just abandoned the product that they were building. They realized we were building the wrong thing, completely ripped it up and said, we got to start from scratch. So you have to be willing to do those things too. So I think we have to change the behavior of the entrepreneurs and the investors into being open to the product we're building isn't something that people really need. And we need to engineer a market. If we find that there is a need for it, we need to engineer the category. We need to engineer the demand for the recognition for how this product's going to solve these particular problems. Otherwise, we're going to continue to see these kind of failure rates. I don't see any change.
Makes sense. So just switching gears to the fundraising side, um, on the founder perspective, fundraising has become more challenging. Apparently, do you see the same thing, or has traction expectations just become more strict because of the environment that we're in? Because if we're comparing everything to 2020, we're at I guess you could argue, the top of the cycle. There's a lot of cash, a lot of companies receiving investment maybe that should arguably shouldn't have. And so now we're no longer in that environment. So from my point of view, traction is just become more important.
Mhm.
What are your thoughts on this?
Yeah, well, the cost of capital is a lot more now. So we can see it in the public SaaS markets. I think we were seeing 10x multiples. I think it's now 5 to 6, so it's dropped back. It's actually not at its lowest. Its lowest was about in 2010, 2011, around there, which is around 2 to 3x. But today, around 5 to 6x. And what you see in a lot of the companies that were funded a few years back is that that there's an impedance mismatch between what the valuation of that company was, right? And you can't take the company public, no matter how well it's doing, if the last round, well, you can, but it's going to hurt the investors who were in the last round. If the valuation was 10x, a revenue multiple, and it's trying to enter the public markets with that, when the rest of the market's valued it's 5 to 6x. Um, and then a lot of the other ones, you just need to expect haircuts in the valuation of those companies, and investors don't like that because they raised, right now they have an unrealized portfolio valuation of some multiple, and if they take the haircut, the mark to market on it, that's going to hurt their ability to raise funds. And as we know, typically only a couple companies, maybe two or three in a fund, depending on the fund size, really are going to generate the returns on that fund from the limited partners' expectations. So I think entrepreneurs are under pressure because if they raise a lot of capital under higher valuations, it's really tough to go out and raise new capital. If they haven't raised, they're brand new and they're trying to raise capital, there's limited funding, there are less funding available because there's less capital available, and that capital is more expensive than it was a few years back. So you need to offer more proof, right? You need to offer more evidence, and so you'll see less in many cases, a lot less capital available to the early stage startups, and more capital available to startups that look like they're doing okay, and maybe they could do even better if the company was able to raise more capital. So it's a tough environment for brand. I've watched it with the own companies that I'm advising. It's a tough market for them to raise capital now, if they don't have a lot of legitimate, the metrics that we would all consider to be the things that we would learn in our MBA program or whatever, whether revenue, margin, etc. So that is an issue. I don't agree with the idea of profitability of these early stage companies. I think the McKinsey report, and I think they did a new one recently, but a McKinsey report around 15 years ago showed that across thousands of different technology companies, the single most important variable for valuation was growth in in all cases. And
Yeah,
they
that
did
was
an
what I was going to ask you, because in the traction gap, you said profit doesn't matter until the company is a market leader and growth starts to taper off. But if you watch the last couple of years, and it's still going on this year, there's VCs on stage talking to companies about EBITDA, which is kind of strange to me because then it's not really a venture investment. I
yeah,
mean, from
there.
my point of view.
Yeah, I mean, I think I mean, if you're a private equity, if it's a private equity company,
Yeah.
fine. That's about EBITDA. This is about growth. And so, if you're trying to play a private equity game in a VC world, that is an impedance mismatch. I still believe that growth drives most of it. You don't. They're worried. The people speaking about this, I believe, not. I don't want to put words in their mouth, but their issue is, shoot, you're running out of capital. We can't afford to bridge you. We can't carry you. We can't find other companies that are other. We need other firms to bridge you to the next, or to put new investment into you. So you need to control your cash burn as much as possible, and generate profits. Um, yeah, I think that then you shouldn't be in the venture capital business. I don't think. I think you should have reserved enough to carry the company. I always did. When I invested, I had enough for the next couple of rounds. We were a larger fund though in those stages, $600 million fund. But I just think that if you're going to do early stage investing, then you need to figure out this market engineering work. You need to figure it out fast, and you need to demonstrate the ability to grow. If you can see a company growing at 50%, 100%, whatever it is, even more with this T2D3 model, people are going to you're not going to have trouble raising capital. The EBITDA thing is, I think, a temporary thing, just because firms are worried about the amount of available funds they have to bridge their existing portfolio companies, and they're the target audience that you're trying to get to invest. So, I mean, they're the ones who define what the product is. Remember, as strange as it sounds, for us, startups are just financial factories, right? I mean, yeah, you have to build another product, but if you could put a buck in and 10,000 came out of whatever side of this machine was, I mean, people venture would fund you all day. So in effect, you're building a financial product for the venture community, and it has to look a certain way for them to
And
make
I
an
would say
investment.
that is one of the key pieces in your book that I use to kind of explain to technical founders on raising money, is that they're selling a financial product to investors versus selling a product to consumers. Because I mean, that's one thing that I think will also never die. I think that will be something that has to be continuously reiterated. And I love the way that you put it together in your book. So I just have one more question
Sure,
on
Josh.
this topic before we move over to the closing questions. Uh, what would you recommend to founders to consider in this current climate? We talked a lot about engineering the market, and we talked a little bit about things to overcome failure rates, to fundraising. So, given that this audience for this episode would largely be startups, what would you leave them with for a recommendation?
Well, the path of progress, I mean, this is no new news. Is, I think, all the systems of record that are out there, I think largely have been, for the most part, most companies have a system of record for nearly every function in their company. The next big opportunity are these systems of intelligence, which are AI native. It could be generative AI. It could be RAG based, et cetera. I mean, there's just a retrieval augmented generation, and a variety of other things. But the way I describe it is based upon another person who invented the term, an agentic system. So agentic systems, I think, initially are going to complement these systems of record, but eventually, I think, will commoditize systems of record and eventually become the primary software that's used across companies. And they perform this autonomic work in the background. It evaluates a process, a transaction. It says this is off model, on model. It makes recommendations to an employee, to a manager, to a director, to an executive. It'll help us plan better, execute better, generate more GDP. I think we can't tax our way to success as a nation. We have to engineer more GDP. And so more GDP is going to come through more productivity, and these agentic systems are going to do it. So if you're going to build a B2B company, SaaS, usage-based, whatever the revenue model is, I highly recommend focusing in on these agentic systems that are going to and explaining how you fit in using the data captured. I call it the digital exhaust of the transactions of companies. You need to figure out how you're going to do this for planning. And again, supply chain management is going to need this. CRM is going to need it. Business intelligence. I think there's a new category emerging called decision intelligence. BI was retrospective and using online analytical processing to look at what happened in the business. Instead, we need an agentic system that's looking at what is happening introspectively and then prospectively what might happen if things continue to go the way they're going. So that way the teams can make corrective actions in time to remedy any issues before the end of a quarter, rather than digging out in the last, getting some kind of Excel spreadsheet telling us, oh crap, we haven't done well, or looking at the report from from Salesforce telling us we don't have enough opportunities in flight. So I think that's the new opportunity for companies. I think I looked at some numbers that in the industry that 30% net new dollars are going to be allocated towards these agentic systems. And it's going to require new architecture for us to take advantage of them. Building on, all the systems of record were really built on relational databases. But these new agentic systems need vectorization capability. They need time series. They need real time. So there's a lot of different components that are required or capabilities required for these agentic systems to be built. And so, looking at new database technologies, I'm on the board of one called Crate.io, which is a European one. I think these are going to be the new pieces, the components that lie underneath these agentic systems. So that's the opportunity. I don't think we need more systems of record, much just like what Phil Fernandez said. I think people have already sort of bought out most of that area. The new area to mine, I believe, are going to be these agentic ones. And I think that's where venture should look. I think it's where the tools, the mining tools, for it. I think the applications that solve these business problems, that people do more, faster, more confidently, more accurately, potentially with less people. And then in terms of training, people need to learn how to use these systems. I don't know whether there's a big market for prompt engineering, I think, but understanding how to engage and interact with these systems is really important. I think ChatGPT gave us some insights into there. It's evolving. Things like Perplexity, other things that we can use to work faster, better, and more productively. So I actually look at it as I wish I was starting my career over because that's where I would be. That's where I would. I started out, like I said, network engineering. I would be in the agentic engineering as a young 23-year-old, like when I first started.
Well, you never know. Like you can always try something again.
Yeah,
Some of these guys, they're serial entrepreneurs till the end.
for
Maybe
sure.
we'll see something there. Yeah. So in going to the general, the fun questions, as I like to call them. The first one up I have is, what are you currently reading? Could be or if you're not reading, it could be something you're listening to. So a book, a podcast, something that's inspiring or influencing your work or lifestyle. Either way, either or.
Yeah. Well, I mean, I read lots of different stuff, fiction and nonfiction. So it kind of just depends, sort of where and when I'm
Oh,
reading
let's
it.
go with fiction. We talked about business for an hour.
So it's sort of fiction. It's like maybe it's nonfiction too, but it presents issues and a variety of other things. I think this whole area around cybersecurity is really interesting. So books like The Kill Chain, this is and or a book. This is How They Tell Me the World Ends by Nicole Perlroth, a New York Times author, about zero-day events and how they lurk in there. It's sort of a docudrama, maybe not really. not really fiction, not really fiction, but a lot of the stories, a lot of the theses in there, are there. I'm kind of
So
James
dramatized
Patterson.
reality.
Yeah, I'm kind of
So you
I
said it's
like
called the Kill Chain. Is that
yeah,
what
the
you
Kill
said?
Chain. That's one, and the other is called This Is How They Tell Me the World Ends. Those are both eye-opening, terrifying books that we should all as citizens read. Um, the notion that all of our software, every operating system, all of our grid, everything, what's lurking underneath the covers are these hidden zero-day events, and those are traded to foreign entities in the dark web. How to unlock them, and
Oh
they're
boy.
they're sold, bought and sold. So it could be created by North Korea, it could be created by a bunch of different stuff, but it's infiltrated everything, and so that means that the ability to turn off our grid, so that would be bad, right? So I find that stuff to be pretty interesting. Let's see, I'll just look behind me to see some of the other things I've just read. Um, Well, I race cars, so this is probably not for everybody. But a guy named Ross Bentley is a pretty famous guy in the racing industry. Wrote a book called Speed Secrets. So I'm reading that. I'm actually off. I race with Ferrari, and so I'm off
Oh,
to
nice.
Italy next week to race in the U.S. finals and the World finals. So there's a bunch of stuff that's interesting to me and important. Last year I took second in the U.S. and fifth in the world, so we'll see if I can improve on on either of those. Let's see what else is in here. Yeah, a bunch of AI books, like the Master Algorithm, some other things like that that talk about just the use of this. How do we use AI? And so, mostly in those areas, if I'm going to read something that's pure fiction, I'm kind of like I like the James Patterson series, those kind of books. That I like the Jack Reacher series, just some of those things that are pretty stupid to read, but they're pretty, they're good on vacation and good just to not have to sort of put your mind in on the other things that are affecting us.
All right, cool. Um, are are there any thought leaders or industry experts that you follow closely?
Yeah, I follow Christopher Lochhead in his pirates sort of. It used to be called Legends and Losers, but his Pirates podcast and his Pirates work, it's all about category design. I like what they do, the work they produce. I think it's excellent. Um, I I think Constellation Research is one of the better sort of boutique industry analysts that I follow. Um, so that that I think is worthy of people spending time on. I know people like to read Gardner or watch Gardner or whatever, but I think that Ray does a nice job at Constellation Research of giving us really good information about new things. So those, in terms of the leaders in the industry, I a lot of in the tech industry, people are pretty biased, so they tend to produce things that are biased towards their company, and I try to stay away from that. I try to get as agnostic as I possibly can, and perhaps that's why I kind of lean towards the industry analysts for that. Most of them, there's a firewall between the paid and the sort of the research side, kind of like in banking, right? The buy side and the sell side. There's a research side and there's the other side that sells. So I do like what Constellation Energy is, and what Constellation Research is doing.
Yeah, I don't think I've read any of their reports. I'm typically searching for mostly Gardner related stuff. And
Yeah, I would
now,
add
like,
Constellation. I think you'll like them. I mean, I think you'll find it to be good. I'm going to have to go here in a couple seconds
yep.
because I've got a thing. So, but one more.
Yeah, one more. Reflecting on your career and your time in the industry, if you could go back in time and give yourself one piece of advice, what would it be?
Yeah, well, I'm the product of two public school teachers, so who were not involved in business, were not involved in technology. I had to kind of find my own way. And so maybe the advice I give myself is the advice I gave my two daughters. One is an attorney at Google now, and the other is a CMO. I said, what I would say is start in large companies and work your way down. Start with a successful large company that has all the different functions operating. They have a market leading position. And then work your way across the different functions in that company in the areas that you're skilled in or the things that you're interested in. Learn from them because there's a lot of structure and resource available. Then move down to a mid-market size company, maybe take on a broader role inside the mid-market one. And then eventually, maybe after 10 to 15 years, work your way down into a startup. I think the problem is if you come right out of college and you are in a startup, there's no mentoring, right? There's no structure. It's all up to you. And maybe you'll find your way and maybe you can do it. But I think that's a really tough thing to do. I think it's much better to start big and work downward. Then you'll know what things work, what don't work, what processes you might want to use. You'll learn from a lot of people. You'll meet a lot of people. You're going to need to have a big network of people to draw upon in these smaller companies. And so invest your time building a network. I didn't really build a great network. I got lucky in that I was part of Oracle, and that became a great network. But I didn't engineer a network. And I think you really need to do that. I think the students who go to maybe some of these top tier universities do a good job of networking, just because the people who they're associating with are already well connected in a variety of areas. But if you don't have access to that, you have to start fabricating a network as soon as you can, because you're going to need to you're going to have to hire people. You're going to have to ask questions from people. You need a big network to help you either as an employee or just period to kind of give you guidance. So that's what I would do. I take my advice on the start big, go smaller, and then on the networking part, I would have started better probably in college, and really created much more of a formal process for staying active.
Oh, that's great advice. So before we close it off, is there any social handles or websites you'd like to share if people want to learn more about market engineering, etc.?
Yeah, if they'd like, they can. I have an advisory that I do. The best way to contact me about it is bruce@forzagroup.com around market engineering. If you want to learn more about the book, it's still on my Wildcat Venture Partners website. It's called www.tractiongapbook.com, and there's a bunch of resources available there for you. And as soon as I complete the complete IP transfer for a bunch of different assets that I developed there, I'll have all this under a different website. But for right now, those are the places that I would go to learn more about this.
Perfect. Thanks for coming on and sharing your insights on the industry. It's been a great conversation.
Thanks for having me, Josh.
You can find information about the Candid Capital podcast on the website, LinkedIn, and Twitter. Episodes can be found on Spotify and other podcast platforms. A quick reminder that this is infotainment and is not intended to be professional advice, malicious, or hateful. The views, information, or opinions expressed during the podcast are solely those of the individuals involved and do not represent those of employers, partners, and their subsequent connected private and public associations or organizations.
We canned it, I hope you understand it. Your business growth, we planned it, yeah. This ain't for show, we stamped it, yeah. Yeah, no FOMO, everyone come join, no solo. This all factual.